We lost Josh.
Hey, everyone.
Hello.
So Natty didn't get a link for to come up. Is there any way we can invite him up, or?
I sent all the links. I resent them to all the listed panelists. If he joins, I can look for his name and promote him. Okay. Okay.
He should join. Yeah, Natty Zola has joined, it says. So he would be the one to promote, please.
Got it. I will do that, and I will play the video and promote him right now. Okay. Have a great session.
Thank you.
Okay. Or maybe not. Screen share. Go. Where's this video? And of course, my computer crashes. Give me 1 second, guys.
Hey there, Noah and Molly, by the way. Thanks for joining.
Hello.
So good to see everyone. I think we're live. It looks like about 38 attendees at this point.
We are, yes. Sorry, my video crashed. I will open it back up and we will get running. Where are you?
Hey, Josh, I think I'm good as a presenter.
Welcome, Natty.
Developer.
I don't know how integral the video is to the intro. If we want to just skip the video, I think we can do that too.
I think we
Welcome
need to do
Denver
it for
Startup
the
Week.
sponsors.
I'm Ben Data, co-chair of DSW.
Perfect.
This year marks the 10-year anniversary of Denver Startup Week. This community has been the catalyst for lots of change over the past decade. And this week, we're coming together to celebrate the past and dream big for the future. We are able to bring Denver Startup Week to this community thanks to our 2021 sponsors. Thank you to our HQ and title sponsor, Amazon, and our title sponsors, whose leadership makes this week come to life. Capital One Cafe, Downtown Denver Partnership, Fluid Truck, Hotel Engine, and WeWork. And our track sponsors, who have made all of the great content you're hearing today possible. Founder Track, Kickstart, Growth Track, Friday Health Plans, Developer Track, Quizlet, Product Track, Palantir, Designer Track, Battery 621 in the Public Works, People Track, Exactly, and Spotlight event sponsor, Strat Labs. Our headline event sponsors are bringing the excitement this week. Thank you to B-Side Fun, Colorado Public Radio, Comcast, Coors Brewing Company, Denver Pavilions, Entrepreneurship at the University of Denver, Gusto, JP Morgan Chase, Method, Moss Adams, Pine Insurance, Promontory Mortgage Path, Red Bull Basement, Southwest, Tattered Cover, and VF Venture Foundry. Finally, thank you to our partner and member sponsors listed on the screen. Please say thank you to these companies as you enjoy our hybrid Denver Startup Week. And don't forget to use hashtag #DenStartupWeek to share your experience and moments of inspiration on social media. Have a great week.
Early risers, all-nighters, slow pours,
Natty, I think
fast
we're
crams,
ready to kick
post-nap,
this off.
on the mat, in the
Unless you want to
stacks,
retry the video,
phone
but I think
down,
we heard it pretty
volume
well.
up, complete silence. You ups,
Natty, are you there?
coffee
Can you hear
cups,
me?
pizza crusts, first semester, fourth quarter, focus 100,
Yeah.
privacy 0, pre-test, one last check, let's go. However you study, Quizlet takes the guesswork out of your coursework. Learn it,
I
own
can't
it,
hear the video
Quizlet.
anymore, so I'm
Hello, everyone.
good.
Welcome
And
to
I couldn't hear the
Denver
video when
Startup
you were
Week.
talking.
I'm Connor
I
Swanson,
can still
the
hear
Developer Track
the video.
co-chair, along with Aaron Clark, and member of the Denver Startup Week Organizing Committee.
Okay, I think.
All
we're
right,
good.
there we go.
Right.
All right.
Beautiful. Terrific. Well, thank you everyone for joining. This is the second time Natty and I have been able or fortunate enough to pull a panel together with investors outside of Colorado to talk about Colorado investment. And so we greatly appreciate you joining. My name's Josh Dorsey. I work and run the Colorado tech practice for Silicon Valley Bank, and we are the bank that works with high growth, venture-backed and private equity-backed companies. Natty, do you want to introduce yourself?
Yeah, hey everyone, I'm Natty. I'm a partner at Matchstick Ventures. We're a seed fund focused on investing across Colorado and the Rockies region and also across the northern parts of the US, trying to find great entrepreneurs in underserved but rapidly growing regions. And super grateful to be here and help facilitate this panel with Noah and Molly to learn more about how investors are looking at the Colorado market. So thanks for having me.
Cool. I guess I'll kick it off first and ask Noah and Molly with two awesome last names. Molly's yours particular. I didn't want to try and pronounce, but Molly, would you go first and just give an introduction of yourself and let everyone know about your firm Drive?
Yeah, happy to. It's Molly Bonakdarpour. Think like binoculars and then go Bonakdarpour. That usually helps people, but it can be a tough one. So yes, hi everyone. Molly Bonakdarpour. I'm an investor at Drive Capital, a venture capital firm based in Columbus, Ohio, which is not the typical place for a venture capital firm. But we're here, for a very specific reason, and I think one that resonates with a lot of the entrepreneurs in Denver. Our fundamental thesis is that companies should be built where they're strongest, and that can mean different things for different companies. It can be about proximity to customers. The closer you are to your customers, the better feedback you get, the better you understand your product and how you're delivering it. Ultimately, hopefully, the faster you can grow. It could be about access to a specific type of talent that's located in one region versus another. Could be access to institutional knowledge. There's a lot of reasons to build companies in different locations. It doesn't have to be only where the capital is today. Capital is actually the easiest thing to move from one region to the next. So when looking for those competitive advantages, we want to find the companies that have identified that best place for them to grow. We have 1.2 billion under management today. Across 4 funds. I lead our healthcare strategy, but we invest across a number of different industries. Think insurance, fintech, robotics, education, really any large industry where technology can disrupt, which hopefully should be all of them by this point. And we will invest across all stages. So anything from the first check into a business to a much later stage, Series D, E, and beyond. And super excited about this panel and being on the Denver Startup Week. We have a number of companies based in Denver and are actively looking for additional companies. So love that we get to be represented here today.
Awesome. Thanks, Molly. Noah, do you want to share a little bit about yourself and your firm?
You bet, absolutely. So Noah Knauf is the last name. I'm a general partner at Bond Capital. At Bond, we are a growth investor. We invest at the inflection point that tends to be Series C, sometimes Series B, roughly around that zone. And our team's investing our 5th fund. First 3 funds of ours were at Kleiner Perkins, and then we spun out and brought the growth practice with us. We raised Bond 1 and Bond 2, which was a $1.4 billion and a $2 billion fund, respectively. And our team over the years has focused on investing in ultra blue chip technology companies. They're going after really large addressable markets that have great business models, are the category leader, and are run by management teams and founders that we think can go the distance to build a 10, 20, $50 billion company eventually. So over the years, we've had the good fortune of investing in a good number of the best that have come out of the technology sector. It's about 130 companies. Of those, just under 30 now have gone public together, amongst them about $1.6 trillion of market cap. And then on the private side, another $400 billion of overall enterprise value across those companies. So $2 trillion of value across the portfolio companies over the years. And more importantly, just an opportunity for us to back and partner with the most exceptional companies that are out there globally in the tech sector. And we'll talk about increasingly where we're identifying those companies. We're empiricists at heart. We invest behind where there's traction and momentum in companies. And one of the trends that we're seeing is that is increasingly happening outside of Silicon Valley. And we'll talk more about that today.
Sweet. That's awesome. Thank you guys. Now, do you want to kick us off with some of the questions that we have?
Yeah, so we prepared, it looks like about 8 questions, which we'll start with, and then we can open up to questions from the audience. Feel free to throw those in the chat and we'll try to get to them. What we want to start with for you is, what do you see as the strengths and weaknesses of the Colorado tech startup venture capital market from your lens, looking at a nationwide level? Maybe we'll start with you, Molly.
Sure. So we, when I think of the strengths of the Denver market, there's a number of them. I think first and foremost is the talent, right? Like, I think there is phenomenal talent in Denver. And when you think of what a company needs, you need phenomenal talent. And ultimately you need customers to grow that business. And that piece is absolutely, increasingly solved for. And something that we've identified as really value add in the market. I think from just as you think about the broader, continuing to mature an ecosystem, just like we see in a number of the other markets where we invest, it's not about like, is there some magical thing that's happened in Silicon Valley that enables it to be what it is today? It's frankly about just continuing to build on that in other markets. And I think we're seeing it already in Denver when you think about some of the successes that have happened so far, the additional ecosystem that's building, the seed investors that are now participating more. If anything, it's growing that initial dollar allocation. What Silicon Valley has done so well is there's angels, there's pre-seed, there's seed, there's so much of an ecosystem to get companies off the ground and get them through kind of the initial difficult times to get to a place where someone like Bond can invest. I think frankly right now, like anywhere outside of Silicon Valley, as you get to the growth stage, it's really mature and really awesome. And there's a lot of competition and great opportunities. It's building out that earlier stage, that seed aspect, and helping to cultivate those early entrepreneurs that Denver has started on, but just take some time. And I think that's where a lot of the opportunity continues to exist, or it needs to be built.
Noah, would you like to add anything to that?
Yeah, I would say just a couple of things. I think we really share this with the Drive folks that have worked together with them quite a bit over the years. Molly and I sit on a board together, and we share a lot of philosophies about the belief in where innovation is increasingly emerging from. And my own view on this, just looking back, if you thought about starting a company back in the early 2000s, and you think about what you do, really one of the only choices at that point was to move to Silicon Valley, find a garage somewhere, find the deep tech engineers that you had, and do it. If you wanted to do it in other markets, there wasn't established seed capital, there wasn't the kind of tech and talent quite at the density that's happened. And what we've seen over the last, now decade plus, is one a sort of exportation of the startup stack outside of Silicon Valley to be available to great entrepreneurial talent anywhere. So over a weekend now, you can spin up an AWS instance and a Slack instance and a Jira instance or whatever you want to use to manage your development operations, and you can find talent kind of anywhere in the world and build a virtual business from any place. And the result of that is that we're seeing where you have that great entrepreneurial talent and where people that want to build something and take a risk and go to find that product market fit is emerging from everywhere around the country, around the world, and in every economic sector. And the availability of seed and institutional capital and willingness to invest outside of some of those traditional hubs is there better than ever before. And the result of that is that we're seeing traction in places that historically hadn't seen it a long time ago. And what matters most for that when we think about individual markets, it's a couple of things. One, look, I actually think the lifestyle, affordability, talent, sort of trifecta there that tends to bring people that want to work there, particularly as you see the outmigration from certain, less affordable, less quality of life oriented places right now. It really matters. And it being a place that people want to come and work and where talent, which is increasingly mobile, can make it. For board members like myself, it's always nice to have companies there, particularly when we do when we do meetings during ski season. So that's a nice extra value add there. But in all seriousness, it's the talent and the lifestyle. And you start to see when that flywheel starts turning, and each of the markets around the country, and I think Denver is a little further and Colorado's a little further along in this, with that talent, having some early successes, having some great entrepreneurs and some sort of mentors locally, and that flywheel starts to turn and you get the second generation and the third generation. It feels like Denver's well along that arc, and that will only continue to feed more innovation and more success there, and that ecosystem getting bigger.
What do you see? I mean, we're obviously excited about the markets here, and I'm sure a lot of the folks on the Zoom here feel the same way. What do you think are some of the weaknesses or challenges that you see for an ecosystem that's up and coming like Denver, like Colorado?
I'll jump in. I'll take that first, and we'll alternate, Molly, so you don't have to get called on first every time. Look, on the weaknesses side, I think it's the inverse of the flywheel, right? Now, it is interesting because it used to be that was extremely local, and that the mentorship and the networks and the sort of the passing down of the wisdom of entrepreneurship tended to happen around coffee shops and coffee meetings and happen locally. There's still a bit of that. And there's no doubt if you show up in certain other markets that are a little further along in that arc, you'll find more entrepreneurs to go sit down with and network around, and you'll just find a little bit more established, ecosystems. But increasingly, you're seeing a lot of that happen virtually, and you're seeing a lot of those connections be made between an entrepreneur that was successful in Boulder and one that was successful in Columbus, right? And they may be connected via a totally different network and a totally different sort of affinity group that doesn't necessarily have to be hyperlocal. And so, definitely important to kind of, and DSW here is important for that, but to build those kind of local networks and ecosystems, and continue to sort of invest behind that, but important, but less important than it used to be.
And it might sound silly, but to me, often, because we see this all the time, right? Like, we invest in companies almost exclusively outside of Silicon Valley, and you get the same type of question, like, how do you build a big company in that location? And so I actually think it's oftentimes the perceived weakness versus an actual weakness that is the hardest thing to overcome. I think Denver has shown time and again, you can build big, successful companies in Denver, and that you do have an ecosystem that can support these early stage companies and provide a lot of that mentorship, whether in person or virtual. And so a lot of it is just the perceived assumption or the preconceived notion that it must be built in one place or in one way. But increasingly, I think we're breaking that norm and showing that it's possible. And so the more that it's done, the less it becomes a perceived weakness, and people acknowledge that this is already happening, frankly.
Well, so everyone take note that Noah will do DD calls or intros on ski lifts. It's a nice little hack if you want to get a meeting with him relatively quickly. So the next thing, it's a little less Colorado specific, but I think still an important topic to talk about as entrepreneurs thinking about venture and what's happening. A lot's changed in the last 18 months, and venture has changed a lot as well. So can you guys give a perspective of kind of what's really changed in terms of VC and looking at non-coastal markets that's really allowed? Like, we've seen the explosion of capital here. I mean, no, I don't know if you guys even had a deal before the last 18 months, and there's now a couple, and so I'm just be curious of what's changed in the VC landscape, and maybe it's a lot of maybe it's the virtual piece, but would just love to get your guys' view on that piece.
Yeah, so I think it is. I think it's a building on a lot of what we've already said. Some of it is the broader trend of being able to effectively rent out the technology infrastructure that you need versus building your entire tech stack and having that clear advantage of one region. So you take that as the broader trend. Then we have this massive acceleration during COVID with the pandemic, where virtual became the default versus in person. And all of a sudden, it fundamentally changes a company's fundraising process, right? Like, now deals can be done completely virtually. And instead of thinking about, you have to think about kind of what someone is trying to determine is, do I take the day to travel to a location to have these meetings for something that may or may not end up being an investment, is a very different calculus than, do I take this hour Zoom and have this meeting, and could it be an investment? And on both sides, both on the entrepreneur side, can I stack 10 meetings back to back and figure out who the best partner is and be extremely efficient? And then on the investor side, just likewise. So I think it frankly just opens up the marketplace for awareness of different deals. Ultimately, you want to still pick the best partner for what you're building, and making sure that partner is not just going to be able to provide the capital, but be able to provide the insights for where you're working, help you with the talent, and help you solve critical pain points. But that first step is huge and changing just the dynamic across the board. And it's allowing investors to go much earlier stage in their investing, because that calculus has just completely changed.
Yeah, I would just add a couple of things. I think maybe somewhat of a, I think it's great for the companies. When I think about it from Molly's and my perspective, we were the ones always willing to get on the plane. We kind of had, to a certain extent, we were believers in this pre-pandemic. And when I look back at the investments we made in the first of our 5 funds, our investments outside of our investments within the United States, not in Silicon Valley and not globally, were about 15% of our fund. And over the course of a few funds migrated to about 30%, 30 to 35% of what we did. And so empirically, we have been for quite some time willing to just get on a plane and go meet a company. I think what you see most notably over the last 18 months is that the willingness of investors and the ability of investors to really interact and evaluate things on Zoom, particularly for those screening calls. I think a lot of folks will still get on a plane to go kind of close an investment to kind of get through the final stages of diligence around it. But that front end has meant that a whole bunch of investors that traditionally were not getting on a plane to go screen investments are now all of a sudden accessible to those entrepreneurs. And so we've seen a lot more energy early on in companies getting real attention from some firms and some investors that they hadn't historically, and that's wonderful for entrepreneurs.
Yeah, to put some of that into context on our side from our portfolio, because in a lot of ways our portfolio has seen this and been a benefit of it, given most of our companies are between the coast. It used to be if a company didn't have like $1 million in monthly recurring revenue, to get access to the coastal firms was extremely difficult. Right, like it, just getting to that screening call, versus now that kind of gating factor has been completely removed. Ultimately, we agree. Like I think getting in person and having that face to face is crucial to understand how you're going to work together. And I do think the best places are still doing that and finding ways to do it. But getting that initial just awareness and being within the scope from the start has completely shifted.
Maybe piggybacking on that question a little bit here. I mean, maybe this is less of an issue, but I think historically companies outside of the coast needed to do a little bit more to stand out. Maybe that doesn't matter anymore, but do you have any advice for entrepreneurs in Colorado on how they should stand out to be on the radar of investors like yourselves or other coastal folks who maybe aren't in our ecosystem on a day-to-day basis?
Can I take that, Molly?
Yeah, go ahead.
I'll make one universal comment, which I think is stage agnostic, and then I'll make a growth-related comment. The stage agnostic comment is, being networked in to now what is increasingly a virtual network to get those warm introductions has just forever been the place with a 10x effectiveness or hit rate than trying to do so on a cold basis. So that's just sort of one, and I think that can increasingly be done and done in sort of virtual forums to be sure that an entrepreneur, for better or worse, raising capital has become a core competency of the kind of modern entrepreneur. And again, for better or worse, therefore, a good portion of said entrepreneur/founder's time can and should be spent in building the networks that get you in a place when it comes time to get that capital, that they're warm introductions from people that know and trust you and can vouch for you. The little bit more kind of growth specific one is, for us, look, I've seen people try to stand out with gimmicks, which at the end of the day, all that matters for us is metrics, performance, and that oftentimes is sort of perceived, or we find out about that by someone's visibility in their own industry. And so the degree to which they're a thought leader, they're at the conferences, they're talking about the success of their company. There's a lot of investors running around these days. And by being a thought leader in your industry, you're going to find the investors that really care about your industry, that have a thesis or a sector focus that is specific to where you are, which are the ones often that are the best. You're going to find they're going to find out about you if you're active and sort of present in your industry.
And then maybe the only thing to add, thinking of the earlier stage, because I think from that perspective, that last piece Noah said is what's super important. It's all about identifying the right fund, the right person within that fund that has a similar thesis to what you're building. Because if you don't create that match, it's really hard for someone to assess what you're building, particularly in the early days. You don't have those metrics. You don't have necessarily the historicals to point to. And so the most important thing you can do is do research, find a way to get in touch with the right person who holds a similar thesis to what you're building, because they will then understand the vision that you have, versus just a blanket outreach to, if someone sends a robotics company to me, I'm not going to know what to do with that. But if you send something in the healthcare space on an area, like if you'll see, whether it's me, whether it's Noah, or someone else, we're out there trying to show our message of what we're excited about, so that those who are building things along those lines kind of can figure that out and reach out with the right type of companies. I think figuring out that match is super important too.
And maybe this is an obvious statement, and you guys will just confirm it, and we can move on to the next one. But I would also say for entrepreneurs, it's probably the most competitive it's been for you guys in the VC world. There's been more capital raised ever before, and so I would assume that people and investors are looking for people playing in those channels that you were talking about, Noah, to get that signal to try and meet these new companies, because it's harder and harder to get into deals and to win things. And so if entrepreneurs are out there, you guys are definitely looking for them. And maybe that's an obvious statement, but I also see that you guys are competing on a lot of levels as well to get into deals.
Yeah. I mean, building those relationships well in advance. My advice to any entrepreneur is take all those inbound, spend a little bit of time. That doesn't mean you have to raise capital. In fact, a lot of the best companies and the best rounds that come together these days are, it's whatever, it's better to for your company to get bought than to sell your company. The same is true for fundraising, right? And you find that when people cultivate those relationships, a lot of things, especially as the traction really starts to happen, you'll find that those entrepreneurs come back to you, or those investors come back to you as an entrepreneur preemptively, increasingly, and kind of puts the control in your hands of the process.
Well, we brought you two on here, not just to provide kind of lip service to Colorado, but you're actually doing deals here. And so I don't know if you guys could share how you got connected to one of the companies and the story of how you met that founder, just to give some tangibleness to the messaging that we're talking about today.
Sure, yeah, happy to jump in first. So I think a perfect example is a recent investment we made here in a company called Sondermind, because it's exactly what we were talking about, right? I reached out to the company, I think 2.5 years before we ultimately ended up investing. It was an outbound driven thing, focused on a thesis that we were super excited about, around not just access to care, but thinking about how care is paid for in the behavioral health space. You cultivate that relationship over a period of time, and frankly, then get to a place where, we're able to preempt an investment in an opportunity and create that opportunity. And I think when you're able to build those relationships over a period of time, and not just that, but when an entrepreneur in that time period consistently does what they say they're going to do, versus like trying, get flashy, like put big numbers out there and not necessarily hit them, or kind of puts only focus on this huge vision and don't show how you can actually get to that. I think being able, when I think of what Phenomenal's founders do, it's consistently do what they say that they're going to do. And when you have the opportunity to build that relationship, it stands out, and it's really exciting from an investor standpoint. And so I'd say that type of approach is one that works really well on both sides. And then when you actually cultivate the relationship and make the investment, you already know who you're working with and can have that fit from the start.
Yeah, so I would echo that. At the highest level, most of our investments in the situations we're able to particularly lean in are situations where we've been following into that company over a few years, and where they've said, hey, this is what we're going to do, and they've gone and done it. And that builds real conviction on our part to be able to lean in at the sorts of valuations that we tend to as a growth investor. We do have 2 investments in Colorado. To your point, Josh, they're both, that's new as of the last 18 months. That's actually new as of the last 6 months. One is Meaty, which is doing natural lab grown protein from mycelium, which is the roots below the mushroom, and applicable to actually a product that can be applied to kind of all forms of protein, which is terrific. And then the other is Sunday, which is a company that started in the lawn care market with a natural product that most importantly was technology enabled to deliver to consumers a tailored product for their specific lawn, but has had the roadmap to what is a sneaky big TAM in all of outdoor home and garden, which is about $100 billion TAM. And we expect, we'll have a product eventually in all of the typically kind of confusing categories of do-it-yourself home and garden. And so on those 2 investments, actually, they're both based in Boulder. So you could say maybe even more specifically, we have a Boulder strategy, but I promise we don't. But they were both ones that, we talked about it. In one case, it was tracking the metrics. And we spent a lot of time poring over second measure data and LinkedIn data. And we're sort of taking all of this and we look for growth signals for companies, which is, when you deliver on the metrics, the investors tend to follow. And so people will see that. And for consumer companies, it's particularly apparent. And in the other, it was a network thing where there was a great investor that had been in the company prior to us. They said, hey, this is one of the best companies in our portfolio. It's actually many of the conversations we have with Molly and the folks at Drive over the years that lead to us identifying the ones that are really breaking out. And so I think an important note to that is, you build these networks at each of these levels. You build the seed network as a seed entrepreneur. You're connecting with other entrepreneurs. That's often a source, by the way, of introductions to us. Is one entrepreneur that either has worked with or we've worked with or just know really well that says, hey, this is really great. This is going on over here. But what's also interesting is you tend to then build at the seed level that network, and that kind of leads to a lot of the relationships that you have in your Series A, which then leads to a lot of the relationships that you'll find in your Series B and beyond. So back to kind of the importance of building those networks.
I just want to point out that the audience wants to know, Noah, what type of camera that you are using, because they say it is phenomenal. And as someone who shared many Zooms with you now, I have to agree that you have a phenomenal camera setup.
All right, I'm going to paste into the chat. I've been asked that a few times. I have I put it on a Google Doc, and I tinkered around with like probably 15 different setups and found the one that works. And I am told that there are actually many in Hollywood that have seen it. I won't name their names, but one famous director saw the setup and said they had to have it and copied it. So I will paste that onto the chat.
Good.
I'll pull up one question also from the panelists that's related to what you all were just talking about. When you say that entrepreneurs say they're going to do it and actually go do it, I think there's some questions around the fidelity of that. Like, is that like literally they're hitting exactly the metrics that they sent out there to achieve? Or is this more high level around, here's the strategy that we're going out to execute on, and they go do that and the metrics then end up reflecting that strategy? Like, what does that actually mean to you when you see a company go do what they said they were going to do?
I'll jump in real fast. For me, it's totally stage dependent in a lot of different ways. For an early stage company, it's delivering on their product roadmap and following kind of their first principles of what they identified. whether it's, you know, a healthcare focused company or something else, whether it's enterprise, SaaS, or it's direct to consumer, all of those things will change, but it's identifying and putting together their product roadmap towards this North Star and continuously focusing on that and delivering on it. And then from a revenue and traction standpoint, while hitting like a certain amount of revenue and being within a certain band of it is important, and I think being able to consistently show that they can forecast and then hit towards those numbers, it isn't just simply that, to the point I think of the question. It's also, are they delivering what they say that they're going to deliver that allows them to hit those revenue numbers? Purely hitting revenue numbers is the output. So it's what is the input that they were focusing on that allows them to get to that output. If someone's off by, you know, a few percentages or doesn't exactly hit it, or they exceed it, like all of those are awesome things, but it's making sure that they have the process in place to focus on the inputs that lead to those outputs that they say they can hit.
Yeah, look, I think Molly said it well. I would add, it evolves as companies mature. The predictability and the accuracy of those forecasts continues to improve, and we fully appreciate that. You know, for us investing at the growth stage, we like companies that have ambition. We know that ambition doesn't always materialize on the exact time frame, but for us, what's much more important is the 10-year strategic vision and how they're going to be a category leader in the middle of there. And often when we sit down with some of our best entrepreneurs, it's what's that 10-year vision, and then they roll back each of the steps to get there. And it's much more about the product roadmap and the strategic movements to get to being that category leader than it is the metrics at any one period of time. Although you know, growth metrics really matter now, and it tends to be a real driver of investment interest.
Great. Next question we want to have here is, we talked a little bit about maybe not standing out and just having your metrics stand out, but what is a story of something that a founder has done to really stand out to you? And this doesn't necessarily need to be some crazy thing that they've done, but you know, how do people get investors' attention this day in this environment?
I think that might be my turn. So let's think about this. I'll come up with a story in a second, but you know, back to what we talked about, what stands out to us as people that are thought leaders in their industry. And when we go to make an investment, most of the time it's having sort of surveyed the landscape and asked around and sort of understood the nature of that kind of competitive space. Who's funded? What are they going after? What's their strategy? And most importantly, when you ask around at an industry, whether it's of the end customers or it's of other investors in the space, for us, we're in the business of signal detection, and so we're out there. We're looking in particular areas, and we just look for like the accumulation of signal. And it's that question when you ask, you know, who's the thought leader, who's out there doing the most innovative things, who's kind of winning, and you start getting back a similar set of names. And it's people that are networked in that industry that they're in, that are that have the visibility, that end up when you ask that short list of the people that are doing something really interesting in that area, you get those names back. And so for us, it just all comes back to depth in their particular sector and subject area.
Yeah, I think there's no kind of silver bullet or like magical way to stand out, because really standing out is focusing on building a phenomenal product in a non-obvious way, focused on your specific insight in that industry, to Noah's point. So there's no best way to reach out from that perspective. It's to focus on building that and focusing, and then finding the people who have a similar thesis to you. So I feel like the question is asking for a secret to how to get that answer. And I don't think there is one. I think it's truly focusing on the product that you're building and really pushing yourselves to figure out the non-obvious solution, because that's usually where the most innovative and insightful, you know, products come from, and the ability to then break out from the field.
You know, I would add one thing to that, just thinking about it a little bit more. There's a sweet spot for PR and media. You know, I think there's some that push it too far, and it's clearly hypey and over promoted, and it just feels like that, maybe superficial. But there's many that I think undervalue the importance of getting kind of the right media coverage of your company and also of yourself as a founder over time, because that's the sort of thing in an increasingly virtual investment environment. You've got a bunch of young aspiring investors at all of these venture firms and growth firms. There are bullpens full of them. For a while in the early days, their job was to move around and have coffee here in San Francisco and take people out for drinks. And now, increasingly, given the environment of what we're talking about, both COVID and some of the structural things, they're looking around the world for things. And you'll find that most of them have a few sectors that they follow, and they very quickly figure out the conferences and the relevant newsletters and the relevant blogs and that sort of thing. And they're going deep to kind of look for ideas, companies to reach out to and to call. And they can try to find it in looking up Second Measure and LinkedIn data and trying to see trends, and that at the later stage. But for the earlier stage companies, they're finding those in two ways. One, they're kind of combing through the seed portfolios of people or Series A or whatever stages before them that they respect, and trying to find the standouts there. Or two, they're reading around. They're looking for signal. They're constantly opening up those newsletters relevant to the area that they're in, and they're reaching out to the entrepreneurs that end up being and the founders that end up being featured there. So I would encourage everyone to kind of invest the right amount of time on the media piece.
Yeah, it's really good. So the next question that we have is, and maybe you guys, maybe the answer is you don't really think about this as much, but I guess, how would you compare what's going on, outside of Silicon Valley, to Silicon Valley? I mean, is there any interesting data points or any interesting thing that you guys would want to make from your perspective or from what you're viewing?
One thought, and this is more from the outside of Silicon Valley view, just given how we invest, is I think entrepreneurs build companies born out of their experiences, right? And so someone outside of Silicon Valley is going to have different experiences, different problems that they see than someone in Silicon Valley potentially. And so when I think about what an entrepreneur should be thinking about in the early days, it's find every competitive advantage that you can. And so it's don't try and be like Silicon Valley, because Silicon Valley is where technology companies have been created before. Take advantage of the market that you're in, whether it's a specific industry that you have, a critical mass of, or it's a specific type of town that you have a critical mass of, or it's a problem that you're constantly facing where you are, or the people around you are constantly facing, and building products to solve that. As we transition to this world where it's far more kind of application and vertically integrated application driven, where you're now seeing health insurance companies that are tech companies, you're seeing you're seeing providers that are building tech company, hospitals that are tech companies. When you're thinking of things in that way, I think actually where you're located can derive a lot of competitive advantage for you, because you're focusing on problems that you are seeing and you are close to. And if you do that, I think that can really become an advantage versus a disadvantage for where you're located.
That's a great point. I don't have a lot to add to that, but it does remind me, when you look around the country, there are pockets of industry that tended to concentrate in actually Molly's location of her headquarters. It was insurance companies, right? And so a lot of the challengers that emerged in Ohio and very specifically Columbus were going after those sectors because there was some amount of talent there, and it was the entrepreneurs that maybe had grown up around it that decided that they wanted to challenge the incumbents. And so, look for kind of what's authentic around you, and for the opportunities that can also draw on that local ecosystem that you're part of.
I'm going to shift gears a little bit towards questions from the audience. So folks who are listening, feel free to put questions in there. I noticed there were two that have come in. more around the earlier stages of a company formation, call it pre-revenue, pre-product, maybe we call these pre-seed or seed stage companies. What have you seen as the sort of coastal or non-local appetite for investing in companies at that stage? Or is that sort of best suited for the local funds to do maybe more of that earlier stage work? And how is that changing over time?
I'll jump in quickly and I can follow. I think very similar to what's happened in the, I guess, later stages, the A and B and C, where particularly as an extension of the pandemic, folks had to kind of convert to a virtual engagement. I think that's happened, and that has just been facilitated. Also, all of the seed funds looking further beyond. Now, there is a certain point of view among seed funds that proximity matters there. There used to be that, just picking up and walking over to the company and kind of standing around a whiteboard. That I think has even that has even cracked a bit with the recognition that a lot of that great interaction can happen via Zoom. And so I don't have the data around it, but anecdotally, my sense is that whereas to kind of get capital from some of the obvious seed investors, for example, that have traditionally been based out of here in San Francisco, you might have needed to be here. Anecdotally, my sense is that they're doing more and more. So you have to find the right connections into them, back to the kind of warm handoff. But to the extent that that you have that, I think you've got a better shot than ever of acquiring capital from outside. I also think there's a lot to be said for the local networks that exist, and it's back to what we talked about. And I think it's particularly for pre-seed and seed with the angel groups that exist and the regionally focused seed groups that exist, that those are great starting points. And in fact, sometimes, as a note of caution, I've seen this, the young companies that are a better fit for there have an aspiration because they heard you're just supposed to go to Silicon Valley to try to do it. And they spend this enormous amount of energy here trying to do that and find themselves with an extraordinarily low hit rate that if had been applied just to, between firms like Drive and firms that are really specific and local to the Denver market, there's a lot of capital available. And I would encourage folks to sort of exhaust that, with a lot of energy in the very early days, before spending a lot of time trying to look in these other markets.
Yeah, Natty, I'd be curious, given Matchstick and where you guys are, what you've been seeing.
I mean, we see a lot of interest in working with a local partner, but also teaming up with a coastal partner to bring two networks together is kind of the ideal situation we're seeing for entrepreneurs these days. Is they would like to have a local partner and have access to a national network as well. So I usually encourage startups to start locally, at least get momentum on your round. Maybe you can raise your whole round. Maybe you can get half of it committed locally, and then use those local investors as a network to the coastal investors. So you're not just showing up in Silicon Valley or New York or Boston trying to meet firms, but you can use the networks of the local firms. Because I think local firms, part of their job, or our job, is to be that connective tissue to the national level networks. And we should be doing that work on behalf of our companies all the time. So I kind of see both. I mean, I think Noah's also right. I mean, there's a lot of companies that sort of like just go straight to the coast, and that's awesome. And there's companies that do a hybrid approach. I mean, we're always obviously biased. We like companies to start with looking locally first, but there's a lot of options for entrepreneurs now, and there's more than ever. So overall, we think that's a good thing, and it grows the whole pie here. So we're happy with it.
It's great advice.
Cool. I see a few more questions here that are maybe not specific to the Colorado market. I think that's fine. We have some awesome folks who are experienced here, and so I'll jump into those. There's some questions around different stages. So with a really hot market right now, are you seeing, what are you seeing in terms of folks maybe moving earlier to potentially try to get access to companies, but also balancing that with it potentially being less de-risked if you are investing earlier? Like, what are you seeing in the ecosystem around sort of stage and cycle creep among firms?
Well, I think this is a huge trend in the market, as I think Noah would agree. We're seeing increasingly funds that are later stage moving earlier and earlier, whether it's Tiger leading a seed round or Coatue doing a Series A, you can name it. I think, to me, the risk level has to always be it's again a calculus of the risk versus the return. We're all in a business of identifying outsized returns compared to the risk that we're taking. And so if you focus on the fundamentals of massive market with a catalyst or a why now and a unique insight and a person who has that institutional knowledge to deliver on that massive opportunity, the stage, depending on the firm, you might want a stock to drive for earlier stage and bond for later stage, and you want to make sure you have the right fit. But you're absolutely seeing people moving earlier and earlier stage. It's just, that's where you get more economics. And then you just want to make sure who you work with is best set up to then help you with the pain points you are going to face at that stage, right? Like, it's not just about capital at any given stage. It's about capital plus, like a Matchstick who can really help you unlock your local market, or similarly like a Drive or a Bond who then has this network of a ton of different companies in their portfolio with learnings and important things when you get to those later stages. So capital is a commodity. You want to make sure that you then have the fund that's there and the firm that's there that can then help you get to that next stage, no matter when they're investing.
So I had a couple of things. First, I would say, and I can say this actually empirically, there has never been a better time to raise capital as a founder or an entrepreneur, ever. And that's a function of things that Molly talked about. Early stage folks are going later stage folks are going earlier. That kind of all crosses to a place that benefits the entrepreneur. And so that's sort of one comment to make. The empirical data around it, and we actually recently did this. We pay a lot of attention to the top of the funnel flow globally for us, which is seed investments that are made. That actually matriculates at a pretty consistent level from seed to A to B to C. And if you looked at the 5-year period of 2005 to 2009, there were about 2,900 seed investments made that were kind of institutional grade. They showed up in PitchBook, that sort of thing. Fast forward to the most recent 5-year period, there were 29,000 made during that time of institutional seed investments. So it's 10x the number of companies that are getting funded and therefore the access to capital, and then downstream from that, all of it. So I would say in general, there's risk capital at all levels of risk as early as it gets. Frankly, increasingly willing to go after pockets of the economy that previously might not have attracted capital. Things in big ideas in aerospace and industrial and aviation, transportation, logistics, healthcare, education, financial services. Tech is not just contained to tech anymore. It's really, in a lot of ways, all those investors are, in a lot of ways, they're generalist growth investors. They're just investing in technology-enabled businesses that are going after all of these areas of the economy. The last comment to make, and Molly mentioned it, just as it relates to finding the right partner. My first piece of advice in general is, it's a great market. My favorite saying there is, when there's water in the trough, drink it. Take what you can get, to the extent that you have the good fortune of being able to choose, which is not something that all, as much as we talk about how easy this market is, the reality is that that's also contained to a small set of companies that happen to tickle the fancy of these institutional investors. And we know how hard it is for the small business and earlier entrepreneurs that are out there, trying to kind of get that attention. To the extent that you do find yourself in a place that you're privileged enough to make those decisions, I think we've seen a lot of creep, scope creep and stage creep from later stage people going earlier and early stage going late. And I would say in general, there's I think we'll find there's a lot more art to this business than just writing the check, and therefore really favor somebody who has an understanding of your stage, your industry, and your geography.
Yeah, as Molly was talking, I'm looking forward to seeing the Matchstick Drive Bond capital stack for the next company next year.
Wow.
So like, this is a goal we could all work towards as we're doing this. Natty, we got a few more minutes left. I have a question, but if there's a question, if there's a good question in the audience, I think we should go there. Or I can ask a question to Molly and Noah.
Go ahead with your question. We have some good ones in here, but go ahead with yours and we'll see if we can get to more. Okay.
I wanted to ask you guys about the trend that you're seeing within your portfolio companies on hiring and any tricks around that. Every company I talk to is always focused on hiring, and we've seen a lot of people now just say, hey, we'll hire anywhere. Some people that are building actual stuff, and so they actually have to have people in a lab or in a warehouse building things. Is there anything interesting or something you'd point out, a trend that you're seeing that kind of helps with the hiring, or is it that's just a problem that everyone's having, and good luck solving it? And if you have any good ideas, probably send them your way. Is that the message? But I'd love to if you have any thoughts with your portfolio companies.
I'll share a quick story of this. We made a new investment recently into a company that's young, probably maybe 100 employees or so, but has a plan that they need to get to 500. And we're going through the board deck and we're going through the metrics and the customers and the product roadmap and all of these sorts of things. And there's a lot. And I sort of paused the meeting at one point in time and I said, okay, this is great, but like, what's the one thing in this whole list, guys, that's the rate limiter for your business right now? And the CEO paused, and it's a great founding team, and he thought about it. And he's like, that's not even on this list. It's hiring. It's literally just the people. That is our rate limiter, Noah. Like, we cannot move. We would move so much faster if only we could find those 10x engineers. And my answer to him, and there is no silver bullet, but my answer to him was, then it feels to me like that needs to be the first thing we talk about at the board level, first of all. But second of all, you've got all these great product pods going after all this stuff. Just pause and allocate a good portion of your senior leadership's attention and your organization into productizing how you want to solve this problem. And it's going to be different for different people. And for some of it, it's going to be that you need the top of the funnel lead work that you need to do. And for others, it's going to be that you need to think about aqua hiring, or you need to find this other team. But develop the same hiring sort of strategy and plan that you would for the rest of your business for that problem, and find something bespoke to you.
I was really hoping you had a silver bullet, because I was in it. But I actually think that last piece is exactly right. You have to treat this as your most important product in your business, and you have to build it like a product. Actually, our most successful talent teams, the head was a former product manager who then decided that talent is the most important product within a company. And so she was going to move over and think about talent like a product. And I think that is the key here. And it takes time, and it takes process, and it takes discipline. And it should always be the top of the agenda for any important meeting, because it will be what leads to someone's success or keeps a company from getting to their most success.
100%.
I heard an interesting term yesterday that there's not silver bullets, but you can do silver buckshot, which is more about like trying a bunch of experiments to see what ends up being the silver bullet. And I thought that was an interesting mindset. So great. Well, I think we'll wrap up here. There's some good questions in the Q&A. People can reach out to me if their question wasn't answered. I'm just Natty at Matchstick Ventures. Molly and Noah, do you have any parting words, any calls to action that you want to leave this audience with?
No, I think I saw in there a couple of people are asking for how to connect too. I'm Molly at drivecapital.com. I do our healthcare investing, but we invest across a number of areas. If people have exciting things that they're working on, just like Natty said, reach out and we'll try and find a way to work together.
Similar, I'm Noah, N-O-A-H at bondcap.com. Feel free to reach out. And I guess the last piece of advice is just, this is, there is not a startup or a company that I have worked with that didn't think it was over many times on the path to success. It's not a straight line. It comes with its dark days. Entrepreneurship does, the bottom of the roller coaster, and you find these things are not a straight line, but with perseverance and the right attitude and really sticking with it, smooth out to something that creates a lot of progress. And and a lot of value and impact eventually. And so stick with it. It's being an entrepreneur is one of the most volatile, hardest things that you can do. But it's that perseverance that ultimately builds these really big companies.
Great way to end it. I will thank you both for, committing your time, and love that you're committing your capital here as well. And hopefully it's going to lead to a lot more. Natty, always fun to do this with you, buddy. And thank you everyone that's tuned in.
Thanks, guys.
Bye, everyone. Thank you.
Everyone.